Good morning, everyone. Welcome to this rundown for global stocks and commodities for the 17th of November. We saw a strong breakout in the S&P the week before last, and it certainly continued on throughout the week just gone. And not only is it the US, but we're seeing very strong markets pretty much all the way around the world. So this is not just a US story at all. And I guess the interesting thing about that is it's despite the fact that economic growth is soft. It's poor in Europe, it's poor in Japan, it's poor in a number of places. We've still got Brexit, and yet we've still got stock markets doing really, really well, and including emerging markets as well. But we'll come back to that. So the rally truly is a global situation, and the reason that that's important is because when you get that sort of coordinated market advance, it's generally very sustainable and it generally runs a fair way because these things don't stop and start in a matter of a few weeks or a few months. So the fact that it is so broadly based is a very, very positive backdrop for equities. I'll have some more to say specifically about the US market because I think it's a bit overbought at the moment. But on a medium term view, things are looking pretty good. However, the media would tell you otherwise. You would be forgiven for thinking that stock markets were already in decline and about to fall over the way the media treats the subject. All they want to talk about is all the problems that are out there. The other thing that I'll be looking at, of course, is what's happening in the gold sector. So I was away last weekend, so there wasn't a video, and we did get quite a sharp fall in the gold price, about $60 an ounce. And that seems to have stabilised, but let's have a closer look at the gold sector. And Portfolio Analyst is just really exciting at the moment because there's just so many great opportunities in Australian small and mid caps, and we're just continuing to ferret away and identify those opportunities and build a game plan around capitalising on it. So American stocks, the S&P was up by another 27 points across the week, so it was again just a little bit under 1%, and I think that's the sixth consecutive week of gains in the US market. Investors obviously relatively happy with the earnings season, despite the fact that earnings actually went down by about 1% quarter on quarter, year on year, because obviously in 2018 we had the Trump tax cuts, which brought forward an enormous surge in earnings of something like 25%. So 2019 was always going to be a year of flat to negative earnings growth. But I remember about 6 or 8 months ago, the prediction was that earnings would fall by around about 4% in 2019, and it's going to be better than that, that's for sure. And we're still seeing an extremely high level of earnings beats as well. It's up around the 75% mark, particularly in healthcare and in technology. They're the areas that are beating with the highest degree of or highest percentage. We've also got a pretty happy consumer in America as well. Retail sales figures are going quite well. Jobs growth is going well enough. So there's really, it's a pretty solid underpinning for the US economy at the moment. And looking at some other data around the world, it's stopped getting worse, particularly in Europe. So it looks very much like the global growth is sort of carving out a bottom, that we've seen the worst of it, and that from here it's probably going to get better. Now that might be painfully slowly, but as long as things have stopped getting worse, then the stock market will start looking ahead and start pricing that in. We've got this incredible situation that the global rally just keeps rolling on, and it has been rolling on now for more than a decade, and certainly for at least 5 years since people really started getting a bit shrill about calling an end to it, and they still do. And look, if you start with a bias, if you're someone that just in your subconscious thinks because a bull market's been running for 10 or 11 years, therefore it must end soon, and that's not an abnormal position to start with, but if that's your bias, then you're going to go and find what you're looking for. You're going to look at the price charts, and you will find a bearish formation if that's what you're looking for. I can promise you. And I know, because I get lots of questions from many people during the course of the week. So I know what people are sort of looking for and how they're thinking. So, just be aware whether you're actually starting with a negative or a bit of a fearful bias, and therefore you end up finding what you're looking for. As far as I'm concerned, particularly in Portfolio Analyst, as members of that service would know, we've got a 10-bagger portfolio which is being built, and that's only been running for a handful of months, and we've already got a triple and a couple of doubles already. So that's what I focus on. I don't focus on this big picture of what might happen with the index or what the Fed might do. I just focus on what it is I can control, and there's just some very exciting stories in Australia. So that's what I look for. Short term, the S&P is overbought. So a bit of a pullback would not surprise at all. In fact, I hope it does, because it's getting a bit frothy and therefore unsustainable. But technically, it appears to have pretty long legs yet, and I'll explain why when we get to the chart, because it took a long time for this breakout to occur, and when you've built up that much potential energy, it goes a long way for a long time. So I wouldn't be at all surprised to see this bull market march on for a couple more years yet. Now, the US dollar finished at 98.16, and the 10-year yield was slightly higher at 1.83. So let's just have a quick look. So there's the S&P, and you can see here is the breakout, just over 3,000 points, and we finished at 3,120. So we gained about 100 points now from the breakout. And if you pan back and take a look at this whole consolidation period, we formed the first peak when the market really blew off in January of 2018, and we then got a series of subsequent peaks which were a little bit higher, but really this is one whole big consolidation process that's been in play now for about 21 months. So when you get that degree of consolidation, and particularly when it appeared that it was all breaking down, as it did at the end of last year when the Fed was raising interest rates, and that really spooked the market. So when you've had a very quick and partial breakdown, and then you just march back to new highs, and this is not a guarantee, because nothing is guaranteed in this science, but the overwhelming odds are that this will continue higher for quite some time, possibly several years, and could go quite a distance. I wouldn't be at all surprised to see this trading above 3,500 points within the next 12 months, and possibly sooner. So that's the only way that you can assess the US market at the moment. Trade what you see and not what you think. So you've just got to try and push all those thoughts to the background. If you do have a bias that is a bit fearful about the market being overvalued, or overbought, or over something, you just got to get past that and just trade what is. And that mantra has worked incredibly well over the last 5 years. So that's the US market. Now, just on the breadth issue, let's just look at the breadth in the US market. So this is the triple Q. So this is the Nasdaq. So you can see the Nasdaq is also broken out in a very similar pattern to the S&P. So we've got all-time highs there. If we look at the Russell for small caps, okay, we're not at new all-time highs, but we are pretty solid. It's stayed within this trading range all year, and it's back to the top of that trading range. Let's look a little bit more broadly. Let's look at the French. So everyone knows there's a lot of economic troubles in Europe. You would expect stock markets to be heading down, but This is the French CAC. Okay, not quite at all-time highs. That's pre-GFC, but pretty close to it. And look at the rally that we've had over the last 4 or 5 months. You know, stock markets are forward-looking. The data indicates that there's every chance that global growth has carved out a bottom and that it gets better from here, albeit maybe slowly. And stocks are very good at pricing in where things are going, not where they are right now. And that's clearly what these stock markets are saying. Let's look at the German DAX. Again, we're not at all-time highs, but we're pretty close. And you can see it's been quite a strong rally despite the economic data. Let's look at the FTSE in the UK. Now, given all the problems they've got with Brexit, you would have thought that the FTSE would be looking a heck of a lot worse than that. It's only about 400 points off its all-time highs. So wherever you look around the world, and you know, I mean, we've got stock markets like Russia, one of the best emerging market stock markets, is up 37%. You've got several stock markets in South America that are up by you know, well and truly double-digit amounts. So this is a very, very solid, broad-based global rally, and that's important. All right, just while I'm here, let's look at the US dollar. So we're still tracking generally higher. You can see we're in a channel that's tracking higher, and we're sort of sitting in the middle of that channel at the moment. So probably in the short term, the US dollar can go either way. And while I'm here, this is the Aussie dollar, and we're still tracking clearly in a downtrend. And it's a very, very nice downtrend, as you can see, because the red line, the 200-day moving average, is pretty consistently down, and so's the trend line, and it's all lined up very, very nicely. So that's the reality of the Australian market. So 68.18. We were trading up above 69 for a lot of last week, but then the jobs data really poked a hole in sentiment, despite the fact that the US dollar was a little bit weaker. And I still think low 60s in the next year still looks realistic, both from a fundamental point of view, so that's what the economics would dictate, and also where commodity prices are likely to go. But also just look at the trend. I mean, you've only got to just extrapolate the trend on the same rate that it's been going down for the last couple of years, and you get down into the low 60s without too much trouble at all. Now, our index was up by 70 points, or 1% for the week. Now, I get questions about dividends. And I was away last weekend, and one of the people that I was staying with, I had a very interesting discussion about dividends, stocks, and capital gains, which I'll relate to you because, you know, some of you might find this relevant. If you want dividend-paying stocks, you know, if you're retired and you want a dividend stream, and that's how the mainstream thinks, that you should only, you know, try and get a dividend stream, that you don't really count capital gains as a return that you can access, then my overwhelming recommendation is that you also seek growth, because the majority of the stocks that are regarded as the blue chip, you know, stable dividend payers are also pretty low growth companies. Obviously, the banks lead the way at the moment, and they're in the process of cutting their dividends. But so many of the typical growth stocks, so many of the typical dividend stocks, higher dividend stocks that the Australian public goes for, are really quite low growth or even negative growth companies. So my overwhelming recommendation would be to be looking at growth as well as the dividend. We've seen the banks cutting their dividends, and many other of these sort of stocks either have cut their dividends, like Telstra, for instance, or they will have to in the future. So, you know, I think it's certainly a problematic area. Just consider if you bought into a stock now that was paying, let's say, a 2.5% dividend, what will that dividend be if the dividend is growing at 30% per annum? and there's quite a few stocks that I'm extremely keen on from a growth point of view, where the dividends are already growing at that rate or higher. And if that is the case, then what will be the capital gain that goes with that? In a couple of years, your dividend could be 4 or 5%, plus you've got a whole whack of capital gain as well. If you follow this traditional path, it's going to hold you back quite a lot. And the essence of the discussion that I had on the weekend with this particular person, who just couldn't get their head around the fact that they should look at higher growth stocks, and if they needed more money for cash flow, then you just sell a few shares. You sell a couple of percent of the shares that you own, because their thinking immediately defaulted to, well, what if I've got to sell when the share price is down? Or how will I know whether the share price is down or up? And of course, my answer is, well, it doesn't matter. It's irrelevant. It's just cash flow. And, give me any day a stock that is growing at 20% per annum and paying a 2% dividend, or even a zero dividend. Give that to me every day of the week, rather than trying to buy into something that's got no growth, no capital gain, but might give you 5% or 6% dividend now, with the risk that the dividend could be cut. To me, the comparison is about that obvious, and I'm surprised at how many people have trouble getting their head around it. So, if that's sort of the camp that you're in, then I'd really ask you to just sort of rethink the strategy. To me, if you want to protect yourself in the future, focus on growth and not on dividends. And in the Australian market, it's just all about highly reliable small cap growth stocks. Now, that's only a very small percentage, so you've got to do your homework. You've got to be really selective. You've got to be very diligent in continuing to follow the story. But they are out there. We're amassing them in the 10-bagger portfolio in Portfolio Analyst, and also in my other service, the Insiders Club. And they're doing extremely well. So, focus on those sort of stocks, and, don't worry about the media and don't worry about the index. All right, let me just go to the Australian market quickly. So we'll look at the ASX 200, and we're not quite at all-time highs, but as you can see, we're pretty close. So the all-time highs, we formed a double top up here, just where were we, on the end of July, predictably pulled back, and just from a technical point of view, it looks highly likely that this will probably break out to the upside. That doesn't line up with how stocks like the banks and Telstra are tracking, but that's certainly looks from a technical perspective what's going to happen. Now let's look at gold. So here's gold on a weekly chart. You can see we had quite a sharp plunge. So I was always looking for a longer, more complex consolidation after this last really big surge, where we went from 1300 to 1560. So it's playing out pretty much exactly as I expected. Now, I got thrown a couple of weeks ago with this strength here, the week ending November 1, and it looked like, the gold consolidation was over. But, lo and behold, with that big futures overhang still there, eventually the chickens came home to roost, and, we got this big plunge in the gold price. So we're at the bottom of the trend channel. We are at the bottom of this flag. We also are fulfilling some Fibonacci retracement levels. So a lot of things line up in this sort of 1450 area. And so far, so good. Gold has steadied. Now, if we go to GDX, then you can see GDX actually didn't fall all that much in the week when that heavy selling of gold happened. So definitely GDX held up better than gold did. So gold was up 9 to 1468. I haven't seen some new numbers on the futures, the balance in the futures market yet, but it certainly would have corrected itself to a degree. We've come back to important support, but if we look at precious metal stocks, now the one thing that's forcing me to do a bit of a rethink on GDX is that the earnings results for or let me back up one. There's 34 stocks, global gold miners that are in GDX. Barrick and Newmont are the two biggest, and they form about 22% of the index. But other Australian stocks like obviously Newcrest, but also Saracen and Northern Star are also in the GDX index. But GDX is overwhelmingly driven by Barrick and Newmont. Now, Barrick and Newmont, I expected better results than what we got. And there were two things that were obvious. One is that production fell. Even though they got a higher gold price, production fell. And because production fell, what that meant is because the costs of running that mining operation are spread over a certain fixed amount of expenditure, that means that the average cost to produce went up. So in actual fact, the profit margin on Barrick and Newmont was not nearly as good as I expected it to be, and it was worse than some of the other gold miners, particularly the ones in Australia. So what we're seeing is a large divergence in earnings results, and because the two biggest contributors to GDX are lagging the pack, then they're going to hold GDX back. So I'm sort of rethinking my American strategy for gold exposure. So more on that in future weeks. Stocks turning higher really should lead gold. That is what normally happens, and I don't see any reason why it won't happen this time. Turning to other commodities, copper was, take out that word down, copper was steady around 265, and it just continues with pretty directionless trading. However, I would say that the supply and demand situation has been favourable now for at least 12 months. It's failing so far to impact the copper price, but I don't see that fundamental balance between supply and demand has improved because there's just been such a long period of underinvestment, nearly a decade of underinvestment, and that means that there's going to be supply shortages. It's just the way that it works. Crude oil is a little bit higher to 57.93. There's the spot copper chart. You can see we've done very little since around May. And there's nickel, come off the boil a little bit, got up to $8 a pound. We're now just down under 7. So that was all about the Indonesian government's decision on exporting of nickel ore. So to wrap it up, my approach is always keep it simple. What you want to look for, and this is just getting back to trying to insulate yourself from the media noise or the noise in your head that sort of tells you intuitively that bull markets that have been running this long have got to fall over. So if you've got those voices in your head, this is what I suggest you do. You go and look for stocks that have got highly predictable, sustainable growth. You then want to enter on suitable pullbacks in those stocks, because if you get in after there's been a pullback in price, then obviously by definition your downside risks are then less and your upside is more. And you then just need to set about managing them calmly by whatever game plan that you decide to use, and you need to resist the media. Trying to predict the next bear market is just a silly exercise. It's just completely pointless, and all it's going to do is cause you a lot of heartache and loss of potential wealth. The next thing you need to do is find some conviction from somewhere to stay the course. Whether it's from somewhere like myself and the services that I provide, or whether it's from somewhere else, you've got to find a way to stay the course, because we're going to have periodic periods of volatility, and if you can do it, there's very, very large gains. You just look at what's going on in the 10-bagger portfolio that I've got running in Portfolio Analyst. They're the sort of gains, and for some of those stocks, those gains have only just started. They've got a long, long way to go yet. So you've got to find the conviction from somewhere, because if you don't have the conviction, you will get thrown offline by the media or by the market doing a bit of a U-turn temporarily, and you don't know whether to hold on to those stocks or not hold on to them. You know, if you don't have a high conviction about what you're doing, it's just so easy to be thrown offline. So, you know, really, really important. The biggest risk, and this might seem like a strange thing to say, but the more that I sort of look at it, I think the biggest risk coming in the pipeline that I can see is the result of the US election. Now, I know that the majority of people can't stand Donald Trump, and he doesn't do much for me either. But the reality is that he came to office pro-business, pro-growth, and was prepared to do something about it. And he did. And it's certainly done a great deal for the American economy. On the other side, particularly if someone like Elizabeth Warren is able to win as a Democrat, then her agenda is very anti-business. You know, Medicare for all is going to impose a massive cost on the US economy. So I think of all the things out there that sort of concern me, it would be Elizabeth Warren leading the Democrats to victory at the end of next year is the one that I think would affect the stock market. Now, that's not a political comment. It's not a comment about you know, whether her policies are right or wrong, or Trump is right or wrong. It's purely a statement about how the stock market will react. And I think if Elizabeth Warren wins, the stock market will react extremely badly because her agenda is just not in favour of the sort of thing that drives the stock market. So that's what worries me the most. Portfolio Analyst, I'm going to be updating, amongst other things, just one of the 10 baggers in the, or one of the stocks in the 10 bagger portfolio that's it just made a really big announcement last week that I think is, despite the fact that the company was already on a tremendous growth path, is an absolute game changer. So very excited about that. All right, that's it for this week. There's my contact details for any non-members, and I'll be back with you next week. Cheers.